Good morning, delegates. I'm Ruthi Rajan, Deputy Editor of the Oath Legal Magazine. Dubai Chamber, Pinsent Masons, and the Oath Magazine would like to welcome you to the webinar on COVID-19 and value-added tax in the UAE. We have had an overwhelming response for this session and would like to thank you all for joining us today. On behalf of the Oath Magazine, I would like to thank Dubai Chamber for the opportunity to organize this webinar. As we all know, Dubai Chamber's mission is to represent, support, and protect business interests in Dubai. It remains committed to build a knowledge-based, competitive economy and makes it able to adapt with the changes, requirements, and new rules. I would also like to thank the law firm Pinsent Masons, who will be sharing their expertise with us this morning. The speaker will consider the impact of COVID-19 from a VAT perspective and highlight key considerations for businesses operating in the UAE, with a particular focus on strategic ways to minimize VAT costs and support optimal cash flow for the business. Our speaker this morning, who you can see on the screen, is Joanne Clark, Tax Director at Pinsent Masons. Joanne is an international value-added tax advisor with more than 12 years experience of advising clients and corporate groups on VAT compliance, structuring, and technical matters. She supports in-house tax and finance leads with clients across all industry sectors to identify VAT status of their business, their VAT requirements, and offers effective ways of mitigating risk and creating efficiencies within their internal VAT governance. Joanne has a significant experience in assisting clients with the needs of VAT compliance, from basic manual returns to the most modern tax engines for compliance automation. With regard to the format of the session, our speaker will lead the session for the first half, and this will be followed by a Q&A session. Some of you have sent in your questions in advance. The questions will be addressed within the presentation as much as possible. There is also an option on the right side of your panel on both the laptop and the phone to type and send in your queries. As it is a session that is scheduled for 1 hour, we request you to send in queries that are relevant to our discussion today. We would also like to let you know that at the end of the session, a survey will pop up on your screen. Please do take a couple of minutes to fill that out. Over to you, Joanne. Thank you.
Perfect. Thank you so much, and thank you for that really warm introduction, and good morning everyone, and welcome to our COVID-19 and VAT in the UAE session today. Before we get started into today's material, just a very quick background on Pinsent Masons as a firm. It's an international law firm with 25 offices across the globe and over 3,500 employees. In the region, we are based out of both the UAE and Qatar, and we also have an alliance with a firm in Saudi Arabia, servicing a much bigger Middle Eastern footprint across the region. And of course, we need to mention our awards and our rankings. Probably the most important for today's session is you'll see that we were ranked Tier 1 in 2019 by the Legal 500 for VAT and indirect taxes. So really an area of tax that we have expertise in, and we're supporting a lot of clients in the region. So to delve into today's session and use your time as effectively as we can, really these are the key objectives of today's session. So to help you to identify the key VAT challenges that you would have already faced and potentially will continue to face as a result of the impact of COVID-19 to you and to your business. Guidance on some of the VAT pitfalls to avoid that we see many businesses, I guess, struggling with, and areas where they can improve. And on that basis, then also how to optimize VAT cash flow within your business and minimize real VAT cost. I guess it's a time when all businesses are trying to ensure to safeguard their cash flow and minimize their costs, and there's no reason why you can't also do that from a VAT perspective. So that's what we're going to try and help you with today. As we mentioned, there is a Q&A function, and some questions have already come through, and we see a number of themes coming through in those questions. So just to give you some a few of the things that I know attendees today are really keen to get some insights on. So how to minimize the administrative costs around that, how to make VAT cash flows more efficient, key things to think about around registration and also deregistration, and when is that relevant for businesses, things around VAT refunds, penalties, tax authority audits, and also your VAT period and potentially availing of bad debt relief. So there's some of the key things that attendees today wanted us to concentrate on, and we are actually going to cover a lot of these things in our session today. So hopefully we'll be answering a lot of your questions as we go. I thought it would be worth putting this slide up. There are obviously many headlines that we have all seen in the region as we have progressed through 2020 and the impact of COVID-19. Yes, from a health perspective, but also the financial and economic impact of it on our country and also on businesses and individuals in the region. I picked out these few highlights just to emphasize 2 or 3 key points that I'm sure we're all aware of, but it does have an impact on how you might be dealing with VAT and the VAT challenges that you might be facing. So obviously a lot of businesses in the region with the restrictions and not as much movement, not as much tourism, not as much travel, etc., we would see that a lot of businesses, their revenues, their sales have dropped significantly. And this headline specifically is in relation to the banking sector and some of the profits that it has seen drop in the region. And I think, you know, looking at the banking sector in any country is a really good landmark to look at in terms of how well the economy is doing, how well the finances are doing. So that's an important headline. Obviously, the impact of businesses not having as much sales and revenues not being where they would expect them to be has had an impact on jobs in a lot of industry sectors. This is just one example in the airline sector, but we see it across a number of industry sectors in the region. And those job cuts obviously then having a trigger effect around individuals staying in the UAE or deciding potentially to go back to home countries if it's expats that we're talking about. And I think when you take all of that together in terms of the banking system, the revenue of companies, you know, staffs being let go, individuals leaving the region and therefore not spending in the region, we obviously have seen some, you know, stark headlines around the stimulus packages that have been needed to be ploughed back into the region by the government, by the UAE, in order, I suppose, to ensure that businesses can continue to function, that our economy continues to pick up, and that jobs, etc., can increase again. And I think these are important because they sort of lead to some of the VAT challenges that businesses would have seen and would have felt over the last sort of 8 months and will continue to feel, I guess, going into 2021. And we've captured just a snapshot of some of these challenges here. There's obviously many more that your business in particular may have faced. So a common thread running through most businesses is struggling to collect payments from customers, from clients, and therefore bad debts being more of an issue than they would have been for businesses in the past. That's the case in terms of the actual debt itself, that's the amount paid, but obviously that is now increased by the VAT amount, the extra 5% that you would have charged on those supplies of goods and services. And the reason that VAT becomes an issue, because obviously you eventually hope that you could collect that bad debt, but the immediate impact of that is a negative impact on your cash flow. Most businesses in the region are on monthly and quarterly VAT filings, and therefore if you're not collecting amounts from your customers, including the VAT amount, on a timely basis, you then have to finance paying that VAT to the tax authorities, even though you have not yet got it collected from your customer, and that's having a negative impact on a lot of businesses in the region. We already spoke about the decline in sales and revenues. That obviously means that you're not charging as much VAT to your customers, but you may still be incurring a lot of VAT on purchases that you've not been able to contract out of. And therefore, we've seen a lot of businesses shift from being in a VAT payment situation to a VAT refund situation. And while VAT generally should be neutral for most businesses in the region, the difficulty with being in a VAT refund position is that you don't obtain that refund on the day you file your return. You have to separately apply to obtain that refund. And obviously, depending on the value of the refund, you may be audited, you may be asked by the FTA to provide certain documentation. And therefore, in terms of managing your cash flow and knowing exactly when you will get that cash back into your business, that can be a negative impact on your cash flow. We talked about staff redundancies. To some extent, this could have a minor positive effect from a VAT perspective. Obviously, staff redundancies is not a positive thing. However, if there are ad hoc day-to-day costs that you have associated with staff that are not long-term committed costs, they may be reduced as a result of reduction in staff numbers, and therefore you may not have as much VAT on those purchases. But we suspect for most businesses, those amounts would be quite low. The most frequent, I guess, characteristic we see with costs for businesses is that they are committed to a lot of long-term costs. And that does mean that even though revenues may have reduced, staff numbers may have reduced, the VAT associated with these long-term purchases may not reduce to the same extent, because you could be tied into 1 year and 2 year contracts on which VAT is due. And so again, that high purchases VAT, it does make it more likely you'll be in a VAT refund position, and that's the challenge in terms of managing your cash flow cycle. And the last one there is less about cash flow, and really it's more about actual real VAT cost. So what we have seen very common across the region, especially during COVID times, is the late filing of VAT returns and the late payment of VAT liabilities, which immediately have a negative impact on your business, and one that hits your profit and loss account as the real cost in the form of tax penalties and potentially other legal costs associated with disputes in the region. So for example, disputes with other commercial parties, or what we're seeing more frequently, disputes with the tax authorities on the VAT treatment of something, but often on the actual penalties being applied. So this is just in one slide, you can see a flavour of the challenges that a lot of businesses are facing, and that's just a natural knock-on effect of the world we're living in at the minute, the business world that we're living in. And so it becomes, it has always been important to reduce your VAT costs. It has always been important to manage the VAT flows throughout your supply chain, but I guess it becomes even more important now because of these challenges that businesses are facing in the region. These are the pitfalls if we categorize them, and there's 3 main categories. And as we go through the recommended areas for optimization where you can actually reduce real costs in your business, they're generally falling into one of these groups as we go through today's session. The first one is around your VAT compliance. We spoke about it on the last slide, around filing VAT returns late or making payments late, and that immediately creating a real VAT cost for you in the form of penalties. VAT compliance can also cause just general inefficiencies in your cash flow. So, you know, ensuring that you have mapped how VAT impacts your business, right from procurement, the whole way through your different departments, through to sales and through to your compliance team who's actually filing the VAT return, and ensuring that you have sufficient and detailed processes and controls, training, you know, a chain of maybe, as we say, 3 layers of defense. If something goes wrong, who will identify that? Where does the question go? Where internally will the question be answered? Is there external tax expert support that you can obtain of? So the compliance cycle is always an easy win. Looking at your compliance cycle and finding areas where you can reduce the days in which you have to finance your VAT flows or identify real costs and mitigate them is a very easy win for businesses, and it's an area that businesses don't spend enough time on, and that's why we're referring to it as a pitfall. Cash flow, again, and we've already spoken about it, but managing your cash flow in essence will reduce your working capital costs associated with VAT. So things like processing, you know, purchase invoices as quickly as possible, having a very rigid process whereby if a vendor is not giving you a sufficient invoice, that is sent back to them immediately and you ask for an updated invoice to be received. And also, and we'll cover it in some of the remaining slides, having a little bit of strategy around your sales and your invoicing, and when you trigger yourself to have to pay that over on sales to the tax authority, you can also be quite strategic about that to manage your cash flows and ensure that you're only triggering payment to the tax authority when you really have to. And then lastly, obviously, there's the real cost of VAT. Generally, we say that that is neutral for businesses, and we have a slide around this that we'll cover it in a bit more detail. But there's many instances where there are real costs associated with that that are necessary, and there's nothing you can do about it. However, very frequently there are real costs associated with that are unnecessary, and your business could plan for them and actually mitigate them altogether. So, you know, identifying where VAT or something associated with VAT is hitting your P&L, identifying whether it's necessary or unnecessary, and then mitigating the unnecessary costs is a key area that businesses should be concentrating on. So with those three areas, I guess, of what the pitfalls are, we're just going to walk you through, I guess, some optimizations and cost reductions that businesses should be considering, should be applying it to their own scenario and seeing whether they can benefit from that in the region. And before we delve into them, I have two slides really just as a backdrop, because trying to optimize that in your business without having this awareness becomes very difficult. And that first level of awareness is around your supply chain. This slide I put in every presentation I ever do. I usually cover it in quite a lot of detail. I'm not going to do that today just because we want to try and get through, COVID-19 and the optimizations as much as we can. But this slide is really, re-emphasizing how VAT works. And VAT works very different to corporate tax, income tax, withholding tax, any other taxes. It is an indirect tax levied on transactions, not on a company. You would never say a company is exempt. That's not correct. A transaction that a company is undertaking may be exempt. So it taxes transactions. Generally, it seeks for the end consumer to bear the burden of the VAT. And generally speaking, as you go from one supplier in the supply chain to the next, business to business throughout the supply chain, VAT in essence should be neutral. Yes, you have to collect it, you have to pay it over, and there's a timing difference between those two things, and there's administrative costs around being compliant, but the VAT itself generally should not be a burden for businesses. There, of course, is some exceptions to this. So if a business undertakes exempt activities and has costs directly associated with those exempt activities, that VAT on those purchases is not recoverable. So that's one area where VAT is a real cost. And also there are some categories in the law on what we call entertainment or non-business purchases, and the VAT associated with them is also not recoverable. So those two areas are VAT costs that you cannot avoid. However, what we tend to see is that in this supply chain where VAT should be neutral and there should not be any main real VAT costs for businesses, little inefficiencies start creating VAT costs, and little inefficiencies or errors start creating real costs for the business in their P&L. Things like your vendor not giving you a valid VAT invoice, you not filing your VAT return on time, you not putting the correct entity's details on your document, not having sufficient clauses within your contract that allows you to pass the VAT on to the next person in the chain. All of these little things in your paperwork, in your audit trail, in how you do business can create inefficiencies in your supply chain. The second thing that we need to talk about before we go on to our optimization recommendations is your landscape. What is the regulatory landscape for VAT in the region? It's so important to know this so that you know what your obligations are, but also what your rights are if you want to optimize. So at a very high level, we have VAT law that sets out the basic rules and procedures. We have VAT regulations, which gives you all your conditions. If you would like to claim bad debt relief, these are the conditions. If you're going to issue a valid VAT invoice, these are the content requirements. This is all in your VAT regulations. We have tax authorities guidance, which is obviously guidance by the FTA on how they view the law should be interpreted and be applied. It is their view. Of course, you should look at what their view is and try to be compliant on it, but you can have an alternative interpretation of the law and discuss that with the FTA. And the last thing then to be aware of is the tax procedures law and regulations, which in essence sets out your rights. What can the tax authority ask me for? What are the audit procedures? Can I disclose if I've made an error? All of these things are set out in your tax procedures law and regulations. And lastly, we have the administrative penalties law, and that sets out what is viewed as being an error and what the penalty associated with that error is. So this is around knowing what your regulatory obligations are and what your rights are, what you can and you can't do, what the tax authorities can and can't do. And it's really important to know that if you're going to try and optimize that within your business. Okay, we're going to start with something really simple, and this came up in a number of the questions that came through, and it's just around registration, which is a really simple aspect of the VAT law, of your obligations, but it is the first thing you probably need to think about when it comes to VAT. To be clear, there are two thresholds in the UAE, your mandatory threshold, which is 375,000 dirham, and your voluntary one, which is 187,500. This is around managing compliance and mitigating the potential that penalties will be applied to you. So if you exceed the mandatory threshold in the next 30 days, or you have exceeded it in the last 12 months, you have to register. So if you don't do that, then there's a late registration penalty of 20,000 dirham. So that's easily avoidable by knowing what your obligations are. If you expect to exceed the voluntary registration threshold in the next 30 days or in the last 12 months, you can optionally register, but you're not obliged to. So that's good from a VAT planning perspective. Should I voluntarily register? Yes, because I can get VAT back on my purchases. However, it will create administrative costs for me because I need to be registered, I need to file VAT returns, I need to have a resource that will do that. So that is a choice that you can make from a commercial perspective. From a deregistration perspective, especially with what's going on in the region due to COVID, it's also really important to know these thresholds. So again, in terms of mandatory and voluntary deregistration, if you don't expect to continue to exceed the mandatory registration threshold in the next 30 days, or you haven't exceeded it in the last 12 months, then you can voluntarily deregister, and that's a choice. If you have not exceeded the voluntary registration threshold in the next 30 days, or you haven't exceeded it in the last 12 months, you are obliged to deregister. Okay, so that's a really important point. If you're not going to exceed the registration threshold, the voluntary one, 187,500 in the next 30 days, or you haven't exceeded it in the last 12 months, you're obliged to deregister. And there's a fixed penalty of 10,000 dirham for not deregistering on time. Again, a real cost that your business could avoid. Also, deregistering might be a good thing if your thresholds are now much lower and you don't want the burden of having to manage VAT compliance in your system. Other things around registration to consider are VAT grouping. A lot of businesses used this when VAT first came into the region, and they're availing of it. Some businesses didn't choose to use it previously and perhaps could use it now. You need to be a resident business and a related party to be put into a VAT group together. And also every party in a VAT group is jointly and severally liable. So they're the commercial things that you need to think about if you'd like to use VAT grouping. But obviously registering for one VAT group rather than registering independent entities may be beneficial for you. And we'll look at some of those benefits from VAT grouping now on the next slide. So that's your registration and things to be aware of and things that might be relevant for you. If you have a smaller entity that doesn't have as much turnover, maybe it makes sense to deregister it right now. If you didn't register previously, but you could voluntarily register now, maybe that's something you should think of. From a VAT compliance perspective, there's also some easy wins, I'd say, for businesses. So your standard VAT period is quarterly per the law. Then there's a discretion for the tax authority to give you an alternative VAT period. And often we see this being a monthly period, and that's usually where you're in a payment situation or a very small refund situation. However, there has been an administrative exceptions rule issued in the UAE. I'm not sure if it was at the end of last year or early this year. And it sets out a number of things that you can ask the tax authority to accept you from. So we cannot meet this obligation in the law, could we have an exception? And there's a specific list of what these exceptions are. But one of them is that you can apply to the tax authority and ask for a different VAT period. Okay, I think the expectation is that many businesses, maybe who have very small payments or very small refunds, might ask to go on to a 6-month VAT return, and that would be considered by the tax authority. But there's obviously nothing stopping you from asking from going from monthly to quarterly or quarterly to monthly, depending on whether you're on a payment cycle or a refund cycle and what suits your business best. So this might help you with your administrative burden of VAT compliance, but also your cash flow. Penalties around compliance. It's really important to know what they are and be conscious of how severe they are. So if you file a VAT return late, there is a fixed penalty of 1,000 dirham for the first return you file late and 2,000 dirham for every return thereafter that you file late. So if you continuously file VAT returns late, these penalties can clock up really quickly. There's also a percentage geared penalty, which we call a tax geared or time geared penalty. And you'll see I've got different rates listed there. In essence, the way this works is that it's 2% of the outstanding VAT liability for the first 7 days, 4% for the remainder of that first month, and then 1% thereafter with a cap of 300%. You can imagine if you have a VAT liability of 250,000 dirham and you allow the penalties to clock up that quickly 300% penalties, which only takes a couple of months, 300% penalties would be 750,000 dirham. That now means you owe 1 million dirham to the tax authorities. So I guess during COVID times, when cash flow is difficult for businesses and businesses are trying to make decisions, if they're tight on cash, will we pay the VAT liability this month, or potentially will we pay salaries or some other cost? That might be an easy commercial decision to make. Okay, we need to pay our employees or other costs, but you can't make that decision without full information. And the full information is the penalties that you would be facing, and they're being automatically applied by the FTA e-services platform for every day that you don't pay your liability and every VAT return is filed late. So that's really important information to be to know, to have to hand in order to make your decisions. Again, from a compliance perspective, VAT grouping can help. The main benefit can often be when you have entities that some are VAT payable, so they're constantly paying the tax authority every period, and some are in a refund position, because that allows you to net those amounts. It means you don't have to come up with the cash to pay, and you're not waiting maybe a month, 2 months, 3 months to get a refund. So you can net them, and that benefits your cash flow immediately. Also, you've only got one VAT return, so it can reduce your administrative cycle. It removes VAT on intra-group transactions. So again, that's a cash flow burden. And so it can be beneficial, but you need to see if it's right for your group. It's just an optimization that you should be considering, and make sure that you've done some analysis around it for your group. If we look at cash flow management, we've one slide on cash flow management, and then we've one slide on really mitigating real costs. And this is just a selection of things, in addition to just that basic registration and VAT compliance, that you can think of and see, can you optimize your cash flow? So we've talked about VAT refunds. Real simple tip here. If you're putting a VAT refund onto your VAT return, there is a separate form that you need to fill in to actually ask for that refund back. One, make sure that you file that form. A lot of businesses don't realize they need to do that. When you file the form, yes, the tax authority might ask some queries. They might ask for some, maybe your largest 5 input, purchase invoices, etc. Respond to the tax authority on a very timely basis. Give them the right documentation. Follow up if you do not hear back from them. This is cash that you can have in your business. And obviously the tax authorities are dealing with many taxpayers out there, and therefore yours may not be at the top of their list. So, be prompt in following up with them and giving them what they need. And of course, VAT refunds, you may be able to mitigate, as I said, if you put yourself in a VAT group with a business that's in a payment situation. From an invoicing perspective, a really easy win. Again, make sure that all of your purchases invoices are valid tax invoices up front. There are many things you can do around this. Have a preferred vendor program, so vet all of your suppliers, give them the content requirements of a valid VAT invoice, and say to them that the invoice will not be accepted unless it meets those content requirements. Have your procurement team trained so that when invoices come in, incorrect invoices are identified very, very swiftly and are sent back to your vendor to get a valid invoice up front. And then I would say strategically manage timing of sales invoices. I've seen a lot of inefficiencies around sales invoices in the region. The law sets out when you have to issue an invoice, and it also sets out what your tax point is, and that's what we refer to it as when your tax is due. And often it's kind of the earlier of 3 things, which is when you've actually completed the supply, then you have to issue the invoice and VAT is due. Or when you receive a repayment, so if you get an upfront payment or a deposit, tax will become due on that amount, or when you raise an invoice. So there's definitely some strategic planning you can do around this, especially if you've got long-term contracts with ongoing supplies, and therefore it takes a long time for the supply to be viewed as being complete. You can avoid issuing tax invoices until you really have to. So for example, if you have milestone payments, you can issue a request for payment rather than a tax invoice. That triggers the customer to pay, you get the payment, then you raise a tax invoice. And that might be the difference between you having to report that VAT in your November VAT return versus having to pay it in your December VAT return. And that might help you from a cash flow perspective, especially if you've got a 30 or 60-day credit period with your customers. So just being smart around the timing of your tax invoices. Your order to cash and procure to pay cycle, again, this just comes back to processes and controls, having everybody trained, making sure that everything in that cycle is efficient and mitigating real VAT costs from a VAT perspective. Bad debt relief, VAT bad debt relief is built into the UAE VAT law. You have an entitlement to claim it. So if you are in a scenario where you're not getting paid by your customers and you meet the conditions, claim it. You claim it on your VAT return. You do not have to write to the tax authorities. You do not need to send them anything. You claim it on your periodic VAT return. You need to, of course, have paid the VAT over to the tax authorities originally. You need to have 60 days must have passed since the tax point, the original supply. You need to have written to your customer, and you need to have written it off in your books and accounts as a bad debt. So once you meet those conditions, you can claim bad debt relief. And that means that the VAT you originally paid to the tax authority when you issued your sales invoice, you can reverse it and claim that VAT back. So you should be doing that if you have bad debts in your business. Be conscious also that your vendors may be claiming bad debt relief. So you may get a letter from your vendors saying that because you have not paid them, they are reversing the VAT on their VAT return, and that means you have to do the same. So if you deducted VAT on purchases, but you never paid the invoice, you now need to reverse that in your VAT return. So it can work as a positive and a negative. Imports is also a key area where I see inefficiencies on the VAT cash flow, and also sometimes some real VAT costs. So obviously a business can import goods into the UAE itself. It might have a third party importing on their behalf. The customer might import on your behalf, etc., etc. So we see a lot of different structures, and also you have the impact of free zones, in the region on that import supply chain. The tip I would give you here is be very clear on who is the importer of record. The person who's the importer of record, in essence, will have the VAT liability on import, whether that's done by you or done by an agent. That VAT is still your VAT. And therefore, make sure you get valid import documents. If you're not doing the import yourself and you're using a third party, you need to ask them to give you the original import documents so that you have them on file and you can put that VAT into your VAT return. Often I see import VAT missed by businesses, or they don't have the correct documentation, and then when audited, it's creating penalties for them. Imports can also be accounted for on a reverse charge basis. This just means that the VAT automatically hits your VAT return and you don't need to calculate it yourself. But also just be cautious of that. Are you doing that? Is your vendor doing that, etc.? And then free zones. I mean, free zones is an area that we can spend a lot of time on. If you trade in a free zone, you are part of a transaction that involves a free zone, or another party you're dealing with is based in the free zone. You need to be aware of the rules around free zones. At a very high level, the VAT treatment for services does not change if a free zone is involved in the transaction. There are no differences on the services rules. There are some reliefs in context of goods, but it's only where the particular free zone actually meets the criteria to be a designated zone for VAT purposes. So things like Jebel Ali, airport free zones, they qualify, but other free zones like DIFC, DMCC do not qualify. And if it is a designated zone for VAT purposes, it's only certain transactions in goods. So you need to know those rules and be aware of what they are. In this slide, I've actually put free zones in from a cash flow management perspective, because potentially you're not using a free zone or a designated zone for VAT purposes, and it's something that you might consider. If you have a part of your supply chain where you're importing goods to do work on them, and then maybe they're going back out of the country again, or you have a lot of transactions with entities in a designated zone, maybe it makes sense for you to restructure slightly and do some of your transactions within a free zone. So that's something that you could consider. Of course, commercially, it needs to work for your business and make sense commercially, but it is something that may benefit you. Areas of risk, and this kind of goes back to a lot of the challenges that we see businesses facing. So obviously in the context of COVID-19, we've seen a lot of businesses potentially shut down branches, pull out of the region, sell off parts of their business, and maybe they or another party to a contract cannot deliver on the obligations under that contract anymore, and therefore the contract defaults, or there's a commercial agreement to try and resolve it, etc. And these are the kind of things that we are seeing. So I just again, I picked on some topics, but there will be many more that businesses face. Contract defaults. So this is a really risky area, because when we talk about contract defaults, a number of things can happen, which is that if one party to the transaction can no longer deliver their obligations under a contract, It may be the case that the contract gets renegotiated and it gets amended. It may be the case that a third party steps in and delivers the obligations of one of the parties to the contract, or it could be that the contract is defaulted, it gets cancelled, and potentially there's some one-off adjustments or one-off payments or one-off supplies that happen as part of that default and cancellation. And all of these have a VAT treatment, and you need to tread so carefully. If we look to mature VAT regimes around the globe, there's been numerous amount of case law on this, and it's something that you just need to be careful of. And I'd say we haven't really bed down thoroughly the treatment of it in the UAE. But the key test is something being supplied in return for consideration? So if it's the case that the contract already set out supplies that need to be delivered, but you now agree that a portion of the consideration no longer needs to be paid, then that's just a discount. So you just credit note that amount, and you adjust the original VAT invoice. If it's the case that there's going to be a once-off payment, let's say to pay someone to not undertake something, then that could be seen as a service, because tolerating a situation or agreeing to not do something could be viewed as a service in itself. And then you have things like genuine penalties, penalties for breach, and generally penalties are not viewed as being a payment in return for something. They're just a general penalty for default, and that normally would be outside the scope of VAT, and there would be no VAT charged on that. So be very careful on anything, either additional services provided, refraining from doing things, or additional payments being made as part of contract defaults. These all can have VAT treatments, and I'd say these are things that the tax authority will be looking for in audits, because they know a lot of businesses will be facing this in the region. Corporate structuring is also, we're seeing a lot of M&A at the minute. We're seeing a lot of liquidations. We're just seeing a lot of change in the region, competitors buying out other businesses, etc. And we have a concept known as transfer of business relief for VAT purposes under the UAE VAT law. And in essence, what TOB relief states is that if you are transferring all of your business or part of your business, and that part, if it's only a part, is capable of being operated independently by itself, then that transaction can be, or is outside the scope of VAT. There are conditions you need to meet, so things like just a transfer of stock will not qualify as a transfer of business. There are some tricky interpretations around transferring properties with leases in them as a leasing business, and therefore that is a business and should avail of TOB. So you need to be very, very careful on the conditions for this. And you also need to be careful around VAT deduction entitlement on associated purchases. If something is viewed as being outside the scope of VAT, then you can't really be seen to have a cost directly associated with it. So you need to look through to what your main business is and look to your deduction entitlements. But transfer business relief is something you need to be aware of. If you're doing these structures in the region, you need to see does it apply to you, and it may help you if you don't have to account for VAT on a full business transfer. So it could be a benefit, but it's a risk area because a lot of businesses get it wrong. So please be wary of it. Free supplies. So we have these concepts in VAT law across the globe, but also in the UAE VAT law, whereby if you do something that normally shouldn't be viewed as a supply for consideration, so it shouldn't be within the scope of VAT, such as giving free services, giving free goods, a gift, and entertainment to your vendors, your customers, whatever it might be. The deeming provisions state that even though you haven't gotten paid for that and you've done it free of charge, for a commercial purpose, we're going to deem that you did get paid, and we're going to make that, deemed consideration the cost to you of supplying that good or service, and you're going to have to calculate that at 5% and pay that over to the tax authorities. So for example, if you were to give a free gift to one of your employees and it's good, and you don't charge your employee for it, you would have to figure out what the cost to you of that good was, calculate that, and pay that to the tax authorities. A lot of businesses don't do this. They don't know about the deeming provisions, they don't calculate the VAT, they don't pay it over, and the tax authorities will identify it during audit and then creates penalties for you. And you could see a lot of this maybe in the region during COVID, in the sense of, again, maybe around contracting, businesses, they can't fulfill something, so they give something else for free. We can't deliver the IT services that we promised, but we'll give you something else in return. So it's something really to be conscious of around the deeming provisions. Sorry, I've just realized the barter trade, that's a perfect example. So again, if you're making a supply and you're receiving consideration, but the consideration you receive is not monetary. So easy example, a bank in the region wants to obtain IT services from an IT company. The bank agrees not to pay for those services, but in return will give a year's worth of free banking services to the employees of the IT company. There will be no cash passing hands here. The IT company will provide the IT services, the bank will provide the banking services. However, both of them are supplies for VAT purposes. You have to raise a VAT invoice, and if the supply is VATable, you have to charge that and pay it to the tax authorities. So barter is another thing that we see very often in contracting. And again, during COVID, we've seen a lot where businesses can't pay and they offer to do something else in return. So offer a good or a service rather than cash. So this is something to be wary of and be careful around the risks of it. And then lastly, FTA interactions. You know, it's a key area of risk. It's not something that businesses should be fearful of or should avoid, but you definitely should go in prepared and cautious of interacting with the FTA, just because obviously it's the tax authority is there to enforce the law in terms of regulating and auditing, and therefore you need to be conscious of that when you're interacting with the tax authorities. And I just have a slide covering the types of tax authority interactions that you may encounter in the region, and maybe more so during COVID, because perhaps you've made errors, or you haven't paid on time, or the tax authority do undertake an audit on you. So the first interaction generally is a clarification. So this is not a contentious interaction, it's not a dispute, it's not errors, it's just a genuine inquiry to the tax authority asking them to clarify a point of ambiguity. It's something that you can use if you're not sure about the VAT treatment of something and you're afraid to get it wrong. You can submit a clarification to the tax authority. I'll caveat that by saying the tax authority is not obliged to reply, and if they feel that the point is already clear in the law or already clear in some of their guidance notes, then it's very likely that they won't respond, or they'll send you a one-liner to say, please see section 52 or whatever it is of the law. So it may not always get the benefit that you want, but it is something that is available to you. Voluntary disclosures is a disclosure to the tax authority that you've made an error. 2 points on this. Firstly, you do not need to make a voluntary disclosure if you identify an error in a previous VAT return and the error's value is less than 10,000 dirham of VAT. If you identify an error of that value, you can adjust it in your next VAT return. You just put it in with your normal sales or your normal purchases. You don't need to disclose it to the tax authority. You don't need to put it in a separate box. It's very visible to them. And you're allowed to do that. And that's allowed under the law without penalty, without audit, etc. If the error is greater than 10,000 dirham of VAT, then you do need to submit a voluntary disclosure to the tax authorities. And there's been a lot of publications in the media in the UAE recently around recent court cases at the Supreme Court in Abu Dhabi around VAT, voluntary disclosures and the penalty regime. And what I'd say is, there has been a number of cases, and some of the headlines on this is true, but one point that is still important is that if you submit a voluntary disclosure for an error you made and the value is over 10,000 dirhams, the submission of the voluntary disclosure in itself will reduce the eventual penalties that you will pay. It doesn't reduce the penalties as much as we thought they did, and that's what the recent Supreme Court case is about. However, it still reduces your penalty. So if you do not submit the voluntary disclosure, an error you have made is identified through tax authority audit in 6 months' time, in 12 months' time, whatever it might be. The penalties you will incur as a result of that error will be higher than if you had submitted a voluntary disclosure. So that's how you can use disclosures. Tax authorities audits, we are seeing them. We're seeing them across many industry sectors. They're mainly on desk audits. We're not seeing very many on-site audits where the tax authorities are coming out, but they are asking for a lot of information and documentation and asking you to reconcile your VAT returns back to your financial statements, etc. So it's to be aware that that can happen. We've covered penalties. There's fixed and tax-tiered penalties. We are seeing them applied across the board, and they are quite severe. As I said, they can go up to 300% of the VAT liability itself. And we're seeing many cases through the tax disputes process, both the Tax Dispute Resolution Committee and also court proceedings for businesses trying to challenge some of these penalties. And we have seen some success for businesses, but obviously in some circumstances, the court system or the dispute tribunal is happy that the penalty regime has been applied correctly. So just be wary of how severe the penalties can be, and then you have to go through that whole tax dispute process, which can be timely and can cost, of course, in terms of legal fees, in order to dispute them. So it is, of course, better to try and avoid them upfront. These are the key takeaways I have, and I'll leave them on the screen. We've actually covered all of them around managing your compliance, reducing the real cost of VAT, and managing your cash flow. I'm sure that we probably do have some live questions that have been sent through, and I'm going to have a look at them to see if we can answer some of them. But as I pull them up, we did have some questions that came through in advance of the session that I knew we wouldn't specifically be answering it during the session today, so I'll just cover one or two of them. So there was a lot of questions around and do we anticipate changes in the VAT system in the UAE? What about what happened in Saudi? The VAT rate went from 5 to 15, I think, in a 6-week period. And you know, the interaction of the UAE VAT regime with a lot of the other GCC VAT regimes we see in the region. 3 of the countries have implemented it in the GCC and 3 countries have not. So just maybe to give a few comments on that briefly. It was always expected that the VAT rate in the GCC would increase. 5% is one of, if not the lowest standard VAT rate across VAT/GST rate across, you know, 168 countries, I think it is, across the globe. It is a very low rate of VAT. It was introduced because the GCC regime, and specifically the UAE, was historically quite a light tax regime. Our region, we didn't have significant corporate taxes, we didn't have significant income taxes, and therefore it was thought better to start with a low rate to give businesses time to adjust, to give price inflation time to adjust, to give the economy time to adjust, etc. But it was always expected that that VAT rate would increase. And obviously it is better for the region and better for businesses if the rate increases gradually, because it gives everybody time to adjust. So increases such as, you know, 5 to 7% or to 10%, also potentially splitting the VAT rate, so having a higher rate maybe of 10 and a lower rate, let's say, of 5, and choosing to leave some important goods and services such as maybe food products, you know, basic human needs, whether it's services or goods, at 5%, and then increasing luxury items up to the higher rate. I guess that's something that we can probably expect in the region. I'm not sure that the UAE will jump to 15 as dramatically as we've seen in Saudi. That was obviously one of their tactics in response to COVID-19. The fact that we haven't seen the UAE do it, I don't think we should expect that they'll take a big jump like that. But I think we should all prepare ourselves that the VAT rate will increase in the next, you know, possibly 6 to 12 months, maybe 12 to 24 months, seeing a second rate introduced thereafter. So it's something that we do need to prepare ourselves for. Other questions that came in around, you know, the tax authorities in the region taking feedback from businesses, you know, reacting to how businesses are coping, etc. As I mentioned, there are a lot of tax authority guidance notes that have already been released, and this is something you should refer to. Often we see that the guidance notes are released on topics that businesses are continuously sending into the FTA asking questions. So we've seen, you know, e-commerce or digital services guide released. We've seen changes to the real estate guide. We've seen guides around obtaining refunds. So I do think the FTA do respond to businesses in the region. You may not always get a private response directly to your business, but I do think that they take heed of, I guess, what the key challenges are that businesses are facing in the region. One other question that came through, and then I think we'll take some of the live questions. It was around deductions, and we've covered it a little bit, but because we've got so many questions on it, I thought I would emphasize it. So we say VAT is supposed to be neutral for a business. It's supposed to be neutral on the basis that you are entitled to recover VAT and that you do it correctly. And that means, getting your valid VAT invoices, knowing whether you are entitled to recover that VAT or not. And we mentioned things such as exempt activities that do not allow you a deduction, or blocked VAT items, as we call them, such as entertainment and non-business items where you wouldn't be entitled to a deduction either. So I think it's really important for you to be conscious of that and make sure that you get your VAT deduction where you are entitled to it and you claim it early and efficiently. There are some restrictions around VAT deductions in the region, and that's in relation to how quickly you claim them. So technically, the law says that you can claim a VAT refund, so you can claim back VAT that you've incurred on a purchase invoice in the first return that you meet all the criteria. And the criteria is that that expense was used for a business purpose, that it's not a particularly blocked item, and that you have a valid VAT invoice in your hand. So you can claim that VAT in your first VAT return. If you don't, for whatever reason, you didn't process the invoice, whatever it might be, you can claim that VAT on your second VAT return. Then the VAT law is silent. So technically, if you don't claim it in those first two VAT returns, you then are into the self-correction mechanism, which we talked about, which is if it's below 10,000, you can put it on your next VAT return. And if it's above 10,000, you have to actually do a voluntary disclosure. So I think it's really important to also understand that they are your choices when it comes to deduction, and make sure that you're availing of them efficiently. Okay, I'm going to take some of the live questions. One I see there that's just jumping out at me. Can you discuss regarding tax treaty between Saudi and the UAE, please? We did get a lot of questions about the Saudi VAT regime, and that's not surprising given that the VAT rate has trebled this year, and then there's also been a reduction of the VAT rate on some real estate transactions in Saudi only in the last sort of handful of weeks. We're not covering the Saudi regime today, we wouldn't have time, but just on this one question, because it interacts with the UAE, the double tax treaty between the UAE and Saudi is very similar to double tax treaties that we see across the globe, and it's very similar to the OECD model on what ideal tax treaty wording is. For today's session, we're covering VAT. So the main point that you need to understand about double tax treaties, regardless of which country it's between, is that they don't cover indirect taxation. So either the VAT regime in the UAE and the VAT regime in Saudi ensure that there's no double taxation or avoidance of taxation, or they don't. The double tax treaty will not do that for you. Double tax treaties address double taxation in corporate tax, income tax, tax on gains, and withholding tax, and that's it. So double tax treaties won't actually help you from a VAT perspective. Let's see what other questions we have here. So considering the current COVID situation, do we still need to get physical invoices from supplier, or is a soft copy on email okay? So the good thing about the UAE VAT regime when it comes to invoicing, which actually does put it ahead of a lot of VAT regimes around the globe, is that on day one, it allowed digital invoicing in addition to, so e-invoicing in addition to paper invoicing. Obviously, there are some controls that you would need to have around that. So the example given on this question is email. So PDFs can be manipulated, email chains can be manipulated. So I think if you're going to use digital invoicing, which you can, I think you would want to have some secure technology around it that can show your audit trail to the tax authority of when you sent it, who sent it, that the original cannot be altered or amended. So things like digital signatures, there's certain securities you can put on these things. So you definitely can use it, and the law allows you to use it, but I would be careful and make sure that you have sufficient controls that you can prove to the tax authority, if they were to audit you, that that couldn't have been manipulated, etc. Another question we have there, let me just pick up on something that we haven't covered. Okay, in capital asset scheme, can we claim all the VAT in first VAT return after asset is ready? So this is a really good point. We didn't delve into the capital asset regime today. There's a lot of topics on VAT we probably won't have time for. Capital asset regime is where you buy a capital asset, sorry, it's quite obvious, for your business, and that can be a property, that could be land, or it can also be significant, let's say, additions to a building, etc. And depending on the size of that capital asset, so the spend and the type of capital asset, it'll be given a life for VAT purposes. And it's very similar to depreciation from an accounting perspective. And that life in the UAE is either 10 years or 5 years, okay? And what you're obliged to do is on day one, you're obliged to assess, am I going to use this asset for fully taxable purposes for its entire life? Okay, yes or no, or partially. And if the answer is yes, you take a full deduction on day one. If the answer is actually it's a building and half of the employees in that building will be working on the VATable side of my business and half of the employees in that building will be working on exempt transactions for VAT purposes, then maybe you can only take a partial deduction. But what you're supposed to do is every year after that first year, you look back and see how you did actually use that asset for the last 12 months. And if the actual use is different than what your intended use was, you may have to make an adjustment. And that could be a negative swing or a positive swing, depending on did you move it from using it from exempt purposes into VATable or vice versa. So yeah, capital asset regime is really important. You need to monitor. It's another key risk area, I guess, that you need to be careful of. I'm conscious of time. Maybe we can take one more. I'm just trying to find one that I can read. Okay, there's one on bad debts, and because I think that's topical. So I thought you could claim in the VAT return bad debt on payment not received 6 months after, not 60 days. Yes, apologies, did I say 60 days? Thank you for picking me up on that. You're correct, it's 6 months after. So bad debt relief, the rule is from the date of the supply, which would be the date of your valid VAT invoice, if you're not paid for 6 months. Apologies if I said 60 days, and thank you for picking up on that. Yeah, if you're not paid for 6 months, then you can claim bad debt relief. Okay, we have a number of other questions there. Definitely we can try and answer some of those and maybe share some of those answers with you after the session. But I do thank everybody that has submitted questions to our session today, whether beforehand or afterwards. And thank you for your attention. I hope it was very helpful, and I'll hand back over to our host and just like to thank the Oath and Dubai Chamber for having me on this session today. Thank you very much.
Thank you, Joanne. And as Joanne mentioned, if there are any specific topics on questions on the topic that she has presented that you would like to get answers, you can definitely get in touch with us, and we would be happy to direct it to her. Our sincere thanks to Joanne Clark for her time this morning to share insight on COVID-19 and value-added tax in the UAE. Also, we would like to thank the entire team of Pinsent Masons for their cooperation and support. This event would not have been possible without the initiative of the Dubai Chamber. We would like to express our gratitude to the team of the Legal Services Department for their relentless support. I would also like to thank my colleagues at the Oath magazine for their efforts. Thank you, delegates, for joining us this morning. Please do take a minute to fill out the survey, which will come up on your screen as soon as we end the webinar. If you could just stay on your screen, it'll pop up immediately. We wish you good health. Have a wonderful week. Thanks again, Joanne. Thank you.